All right, so my job as a regional economist is to go out and find out what's going on in the economy. My job is to keep my fingers on the pulse of the economy. And to do that, I need to get information from you. So let me ask a question. A year from now, will your local economy be better off or worse off? How many people think a year from now your local economy will be better off? Almost all. How many think it would be worse off? A couple. Well, that's a good sign. That means you're optimistic for the economy, right? Now, let me ask the same question. The United States economy. How many people expect the United States economy will be better off a year from now than where we are now? About 10. How many think it'll be worse off a year from now? About 15. I suppose all the rest think it's going to be the same. Huh? Well, I better give my disclaimer now that the views expressed today are mine and not necessarily those of the Federal Reserve Bank of Minneapolis, the Federal Reserve System, or Bakke Norman. I'm not affiliated with Bakke Norman. The Federal Reserve is not affiliated with Bakke Norman, so I just want to make that clear that we don't have any kind of deal going on at all. So, what about the economy? Well, we're in an economic expansion. Woohoo! What, no cheers? We're producing more than we've ever produced in the history of the world. What's going on? How come you're not cheering? How come you're all like looking at me? Doesn't it feel like an economic expansion? What's the matter? You're shaking your head. There's a lot of people out of work. Unemployment rate in Wisconsin, 7.8%. That's a lot of people. Now, we are producing the most we've ever had. Now, how many people in here are seeing record revenues? Nobody? How can that be? The United States production is at record levels. But nobody in this room is seeing for their own individual. So how about at the individual level? How many people are seeing that this year they'll be making more money than they've ever made in their lives? Wow, nobody. I guess that's why you're not cheering, huh? You're not experiencing this economic expansion. So how come you're not feeling it? How come we're not having huge economic expansion? Our economic expansion is very slow and sluggish. How come you're not feeling a huge economic expansion? What's stopping us from growing fast? I mean, we have all these unemployed people that can work. We have a lot of space that can be used that's sitting empty. We have money that's dirt cheap. How come? Those are the primary ingredients for a huge economic expansion. How come we're not experiencing it? Too much uncertainty. Well, there's always uncertainty, right? What's stopping us from growing fast?
I think there's a tremendous lack of confidence right now.
Lack of confidence? More underline that. What's stopping us? I mean, you have uncertainty. You don't have much confidence. You have a lot of confidence in the room that we're going to be better off a year from now than we are now in this community. What is holding us back? Debt. That's right. There's a whole crap load of debt out there that's not going to be repaid. And people are still we're trying to work through all that bad debt. And that's kind of holding us back. Now, I've only got a few minutes to speak, and you can go and talk about the economy for hours. And we have the economic outlook in our Fed Gazette. Now, who gets the Fed Gazette here? What do you think? What do you think? She's shaking her head, yes, yes. Marge, what do you think? Anybody's going to give an endorsement to this? She's shaking her head, yes. It's good. It's fair and balanced because we really don't have an agenda. We just kind of write about all sides of the story. Now, you can get this publication for free by taking out your business card, and I'll give you this publication for free if you just give me a business card. Well, I guess it's not free because you get to trade something for it. Now, a lot of people complain about what the Federal Reserve is doing. You can help shape monetary policy also by giving me your business card because maybe I could survey you once in a while and ask what's going on. And from that, John, can you help me distribute these? Can you collect cards when you're there? I'll be serving you once in a while. Does anybody get my surveys currently? Nobody? It's really easy. It'll get an email from me. It'll say Federal Reserve - 1 minute survey. It won't take much time. And it's just a little bit longer than pressing the delete key. So please fill out. Jill, I just wonder if you could help me. Could you collect some business cards as well? Collect them as well. All right. That's enough about me and the Federal Reserve and what we need from you. Let's talk about the economic outlook. So we can provide the economic outlook based on our surveys that we do as well as our statistical models. Now usually they both say the same thing. However, it makes me very nervous when people's guts are saying we're going to go this direction and the statistical models say we're going to go this direction. But fortunately, it's showing the same thing, which is very modest growth in the future. It primarily relates to the 9th Federal Reserve District, Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. Now, we're very lucky to be in this district. We have a lot lower unemployment rates. Our growth rates are a lot faster. We have boom areas like the Dakotas in our district, which somewhat spills over to this area. Has any of you seen any of your dirt poor farmers around this area with that sandy soil realize that it's good fracking sand? And all of a sudden their land has increased tremendously in value? That's because the North Dakota is booming. Okay, let me move forward a little bit. I want to show that this chart shows, coming out of the recovery, that North Dakota, Minnesota, South Dakota have done very well. Wisconsin's somewhat sluggish. Okay, so the debt. I want to focus a little bit on the debt because that's really what's holding us back. When bankers realized that they were losing a lot of money, they tightened up who they lent to. And regulations came down that said it's tougher to lend. The Federal Reserve and the other examiners went out and made sure that people were lending prudently. So what you had was a credit crunch. But based on my surveys over the last half a year, we're finding that that credit crunch isn't getting worse. It's actually getting a little bit better. So banks are starting to lend again because they realize that they're borrowing for very low rates of interest and they're lending at higher rates of interest. And so they're thinking, hey, it makes sense for us to lend because we can make lots of money. Now this next chart is the scariest of the whole presentation. I'm glad you're all sitting down. Here we go. Here it is. This chart here shows consumer paybacks. Paybacks on consumer debt. For a long period of time, way back in 1999, for a long period of time, 16 out of 20 people paid their bills every month. And then you had a few percent, the light green there, that, oh, the bill fell underneath the table, I forgot to pay it, I'm 1 month late. Then you have very thin slices of blue, 2 months late, yellow, 3 months late, orange, 4 months late. And then you always have that 2% of the people that said, why'd you lend to me? I'm not paying you back. That can be held on, their models can be counted on this kind of relative percentages for a long period of time. But during the crunch and the crisis, it increased tremendously. So now you're figuring that the people that are 4 months late aren't paying you back either, probably. And so you're getting a very large percentage increase, like a 4-fold increase in bad debt. That's huge. That's a huge amount of losses. And you can see that it troughed second quarter 2010, and it's getting better again. If you take the same trend, it might be 2014 before we get back, 2015 before we get back to the same levels. And not only that, you figure that by the time these people get foreclosed on, for example, if it's mortgage debt, and the bank decides to foreclose on them, and then the sheriff's sale happens, and the statutory redemption period ends, and the bank figures out what they got back, and they finally get it on the market, it might be 2 or 3 years before those houses come onto the market. So that doesn't bode very well for the construction industry, but I'll talk a little bit more about that in a bit. First, business leaders are optimistic, just like this room. They're confident in their own operations. This chart here shows how confident are you for your own firm. 7 out of 10 says, I'm confident my firm's going to do well. 1 out of 20 says, I'm confident our firm's going to do poorly. Then you go to the local, then the state, the national. People are more confident that the national economy is going to do worse than their local economy. Employment. Employment is expected to grow. Here in Wisconsin, a little bit more than 1% next year. So employment is going to grow. The economic expansion is going to continue. However, unemployment rates aren't going to change much. So we have growing employment, stable unemployment. So we're not going to grow that fast, unfortunately. Wages are expected to increase 2 or 3%. Prices might increase a little bit further. This is a diffusion index showing that agricultural producers, retailers, manufacturers, services all expect to have increase in prices. However, the construction industry is expected to keep prices the same. Home building remains very weak. Our forecast model expects drops in home building, in housing starts. Now, I don't believe this model because we've been just devastated over the last 4 or 5 years. And look into it, and our statistical model basically takes a long-term trend, and if we're off a trend, you figure it comes back. However, now the long-term trend is negative. We're producing less houses than we produced 30 years ago. And so our model expects that we'll have negative housing starts, which is impossible. So I don't believe the model. So we survey people. And across the district, except for North Dakota, they're expecting housing starts to drop as well. So home building doesn't look that good. Twin Cities market, things are changing in the Twin Cities market. New sales are going up. New homes coming out of the market is going down. The level of inventory is going down. Now we have about 22,000 houses on the market in the Twin Cities area. That's down from about 30,000 a year ago. So we're seeing that the housing market is bottomed out or possibly past bottomed out. You've seen multiple offer situations go on a lot of properties out there. Now the prices have come way down, so as people in the construction industry are trying to compete to build new places at really low prices. Okay. This chart here where I showed how people aren't paying you back, here shows that same chart for this last quarter across the country. You'll see Florida, 1 out of 5 people aren't paying you back. California, Phoenix, Las Vegas, Chicago, Maine, Western Wisconsin. What about Texas? It looks pretty green. What's going on in Texas? Energy? Didn't they have some kind of laws where you actually had to like put down money when you bought a house? Strange laws that they were. Okay, what about apartments? Apartment vacancies over a long period of time, you see the cycles that go on. Well, multifamily vacancies are going down across the nation and in the Twin Cities area. So the rental market is tightening. What's the response? Well, the response is to build more. They're actually building several apartment complexes in the Twin Cities right now. And there's a lot of permits out to build even more. What about office space? Office, this is a shorter time period, 2006, the same type of cycles, but right now we're pretty much flat. Not much change in the office market. That's primarily due to pretend and extend, in my perspective, from my opinion, where there's a wedge between what the owners value it at and what potential buyers would buy it at. Industrial, same type of cycles. Now, the industrial area is going pretty strong right now. Manufacturers are increasing output. The United States has held the position of the largest manufacturer in the world for a long period of time. And we haven't figured out the numbers yet for this year, but this year might be the year that China overtakes us as the #1 producer of manufactured goods. But they got a heck of a lot more people than us, right? But still, we produce a lot on the industrial side. And so we're seeing some tightening in space there. So we might see some additional construction. I'm not sure. Retail, pretty flat. So you're not looking to have much expansion in the retail construction area either. So to kind of recap, seeing some multifamily and senior family projects being built. The housing market looks like it's kind of bottomed out. We might see some increase in construction, but it's going to be very tight margins. Office space doesn't look like they're going to be constructing anytime soon. Retail space doesn't look like they're going to be constructing anything anytime soon. On the industrial side, we might see some interest in expanding. However, on the industrial side, what makes America so great with the manufacturing sector is we're very productive. Every year, 5% increase in productivity. That means we're producing 5% more stuff with the same amount of inputs every year, meaning that they don't need necessarily much more space because they're becoming that more efficient. Now, I wish I could provide you better news, and I hope my predictions are pessimistic, in that in reality, you all have an outstanding year, not only in your professional lives, but in your personal lives.